So we're going to see three reports: the statement of cash flow, the income statement, and the balance sheet. So we're going to start with the statement of cash flow. So the statement of cash flow is one of the main financial statements that shows how cash move in and out of a business during a specific period. It can be for a month, it can be for a year, it can be for 5 years, it can be for a quarter, it can even be for a week. It just shows how cash moves in and out of a business. And it focuses only on cash, actual cash, cash in hand, not revenues or expenses on accrual basis. It doesn't have accumulated revenue. It's just cash for a particular time period, say for a month or for a week. And it breaks down the cash into three sections, as we're going to be seeing here. So the first section is operating activities. This operating activity is cash flow related to day-to-day activities, like selling of goods and services. For example, Earth Analytics, selling out services in data analysis, paying of salaries, buying supplies. That's cash, right? When you have your business, when you pay salaries, let's say for a month, you can take for the month of July. This month of July, you can track your cash. And where will you get all the details to fill in your statement of cash flow? You will get it from all the books that we saw last time. You will get it from your revenue tracker or from your cash book, because your cash book, you record every transaction and you record the date. So you can just go there and you filter the date for that particular period, say for the month of July, and then you begin to see the various things that you did, and you group them into operating, investing, and financing activities. As you can see, I don't know if I'm showing that screen, as you can see here. All right.
Yeah. See.
So we're saying that operating activities are the day-to-day activities that run the business, like selling of products, selling of goods and services, paying of salaries, buying of supplies, maybe paying of bills or something. Then another cash flow is investing activities. This is now what you invest for a future return. You know, because when we talk about investing activities, you might think that buying of goods or buying of goods, stocking goods is an investment. No, it's not an investment. That falls under an operating activity. It's an operation that you do. It's an operating activity. Now, when we talk about investment here, we're talking about buying of equipment. Maybe you buy a piece of machinery, or you buy a piece of land, or you sell a piece of land, because it must not only be income coming in. It's an activity, which means there is money in or out. So you can be buying a piece of machinery or equipment, selling a piece of land, or selling a machinery, or investing in another business. That's an investing activity. You might have grown in maybe your electronic store, and you want to now invest in maybe online marketing or something. Those are investing activities. And it's both negative and positive, because money can come in and can go out. Like you sell a piece of land, money has come in. Now, when you invest in a business, money has gone out. So that's an investing activity. Those are examples. Then the third one is financing activities. These are activities that you carry out to increase your business, right? Like taking a loan. When you take a loan, it's not an investment, of course. It's not an investment, and it is not an operation or an operating activity. It's a financing activity. You want to take a loan to increase your business. You can issue out shares. Maybe two of you own your business, and at the end of every month, you have to give something to the other partner who is a shareholder. Or it's a big company, and at the end of the month, you have to share dividends. That's a financing activity. You are not doing an operation, and you are not investing. You can be paying, we are paying of dividends or issuing of shares. You can issue shares for people to buy shares. Companies like Microsoft, they issue shares and people buy shares and they trade shares. Or you can pay dividends to your shareholders. So those are financing activities. So that is it for the income statement. So how do you track this? You write the name of your company, you write the name of the financial statement. Here is statement of cash flow, and you write the period for the year ended December 31st, 2024, which means that this is it for the whole year, for a period of 1 year. So you divide it into three sections, as we have said, into operating activities, investing activities, and financing activities. So how will you get the all these ones? You get them from your book, your cash book, your debtors book, your creditors book, as we saw last time. So the net income, this net income should normally come from your income statement. Yeah, the net income or from your cash book. So from your cash book, as we saw last time, where you write the dates, the activity, or what was done, whether it was income or it was an expense. At the end of that period, you should be able to have a total net, which is your net income for that period. So you simply go to that cash book and pick that total for that period and put it here. Now, depreciation here is instead positive, although in the income statement is going to be negative. Yeah, because when equipment are depreciating, it means that you are setting aside some money that you can use, so the value is going down. Of course, the value is going down. For example, if you buy a laptop today for 100,000, so by next year, you're no longer worth 100,000, right? You're no longer worth 100,000. Maybe you're worth 70,000, which means depreciation of that laptop is 30,000, which is supposed to be negative. But now in the income, in the cash flow statement, it is not money that you have given out. You get the point. Even though it is negative because the laptop is now worth less than what it was worth when you bought it. It is not money that has gone out. So it is still money that is in your business. That's why it's positive here. But when you go to the income statement, it's going to be a negative because you value it as something negative because you are losing. That's just the small mathematics that accountants use to play. All right. So changes in working capital, accounts receivable increase. So now in accounting, account receivables, these are money that people owe you. So where will you get this one? You get it from your debtors book. They call it account receivable. That means you have given out something and somebody is owing you money, but the money has not yet come in. So it's still out, right? It's still out. That's why it's negative. Of course, in accounting, when you see the braces, this open and close means that it's a negative amount. So the reason why it's negative is because the money is still out. It has not yet come in. So it's account receivable. It's still to be received. That's why it's negative. And it's still on operating activities because you actually supplied goods to someone and the person has not yet paid. So it's you come from your debtors register. Then account payable. This is now coming from your creditors register because somebody has supplied goods to you, but you have not yet paid. So the money is still with you. That's why it's positive. The money has not yet gone out. It's still with you. It's positive. So you can add other activities, other operating activities, as many as you have. So at the end, you will just sum all of this. If you double click on this one, you see that it's the sum of all what we have. So when you sum all of this, you give you $58,000 because we have 50 plus 10, which is 60. This is a minus. So it brings it down to what? 55. You add this 3 is 58. So that's how you get the total for the operating activities. Then for investing activities, maybe you purchase a piece of equipment and you paid out money. So you see it's negative because money went out. Then maybe you stole an old vehicle for $5,000. Money came in. Maybe that was all you did for investing. Maybe that was all you did for investing. You did not take a loan, and any other all those other investing activities you did not do. So that was all. And if you sum this, you have 15,000 less. What is a negative? Because if it is negative 20,000 plus 5,000 is negative 15,000. You just use the formula and sum it. Then cash flow from financing activities. So you receive a loan. Okay, so let me clarify this. Investing activities is buying of equipment. You can sell a land, you can invest in another business. Yeah. So taking a loan is a financing activity because you are taking money you are pumping money into your business. So we cannot say that a loan, like I was giving an example up here, we cannot say that a loan is an investing activity. Investing is when you are, maybe you are buying a new equipment Like you are doing something to increase your investment. Yeah. Okay, so my network I had some network hitches. So what I was explaining was that, or is that, um you can take a loan to invest in your business. That's fine, but it is not from a positive sense. So it's a financing activity. When you purchase a cube of equipment, it's from the positive sense. You got the money. It's from your your company that you use it to buy the piece of equipment. You sell a piece of vehicle. It's from a positive sense. But when you take a loan, all right. So cash flow, we calculate it the same as we calculated for cash flow for financing activities. We calculate as the same as we calculated for the cash flow for investing activities. And then it gives us a net of $20,000. And so the net increase in cash is a sum of all of the three activities. If I click on this one, you'll see that it is the sum of the three investing activities, the three financing, of course, the three activities which are operating, investing, and financing. Yeah. So when we have the net increase in cash, which is the net amount calculated from the sum of the three activities, we can now add to cash at the beginning of the period because if unless it's a new business that was starting, that you began with zero cash. But now, for example, this is the one ended December 31st, 2024. It means that uh, December 31st, 2023, there was some net cash that you ended the year 2023. So by the time you do the next statement of cash flow, you have to add your net cash to the one that was there for the last period. Or if you're doing it for the month of July, it means there was some net cash that was left for the month of June. That's why you have cash at the end of the period. Cash at the beginning of the period is what was at the end of the previous period. For example, what was at the end of the month of June. So you need to add it to what is now at the end of the month of July, if we are taking July and June as our example. So when you add the two, you have 75,000. So this should be your balance from your statement of cash flow. But take note that this is not what is in your drawer. What is in your drawer in your bank account should come from your cash book, because your cash book takes just cash. But this one takes information from all other registers, right? Because we have taken information from the creditors, from the debtors register, from the creditors register. You get the point. And even from arrears from the previous period. So you need to start from what we did last time before you come to this one. All right. So that's it for statement of cash flow. And we are going to income statement. But I want us to look at the two, income statement and balance sheet. Let us even see what they are before we even go to income statement. So what are they? The income statement shows a company's performance over a period. It is similar to statement of cash flow, but it does not track cash in and cash out. It tracks the company's performance. So in this case, if you want to check if a company is profitable, you can choose, you can just ask them to give you the income statement for a particular period. From there, you can be able to analyze to see if they're profitable or not. And this can help to, this is what investors use to be able to see if they should invest in a particular company. So the income statement tracks a company's performance over a period, say maybe 1 month, 1 year. Meanwhile, the balance sheet shows a company's financial position at a particular point in time, a snapshot. So it also helps investors because you can just say, okay, I want to know how your company is doing at this point in time, as of today. So as of today, July 4th, 2025, what are your assets? What do you own? What do you owe? How much do you have? That's the balance sheet. So it's just a snapshot of the company's performance at a particular point in time. But the income statement is for a period. That's the difference between the income statement and the balance sheet for the purpose. Now, the time frame, as we are saying, it covers a specific period, say July 1st to July 31st. That's our income statement. But for a balance sheet is at a particular point, say just July 31st. Just tell me how you are doing as of today. What is your net worth? As you always hear, they say the net worth of Bill Gates is this, the net worth of Elon Musk is this. That is from what? The balance sheet. It's not as if they have some money. If you say the net worth of somebody is $24 billion, it's not as if they have $24 billion saved in their bank account. They might not have physical cash anyway, but it is what? From their balance sheet, a net of what? Their assets and their liabilities. All right. So main purpose is that the income statement helps us to track profitability. Is a company profitable? Meanwhile, the balance sheet helps us to tell the financial position. Do you have assets? Do you have liabilities, or do you have more assets or more liabilities or more equity? Are you liable to go bankruptcy if you have more liabilities? So it's a very interesting financial stuff. And the elements that you mostly see on the income statement, you have the revenue, you have cost of goods sold, expenses, net income, things like that. But on the balance sheet, you always see three things. You see assets, you see liabilities, and you see equity. All right. Then how is it used? The income statement is used to calculate profitability ratios. Like I was mentioning last time, you can read more about this. At spare time, you can read about current ratio, debt to equity ratio, gross margin, and things like that. Return of investment. This is a very important concept in finance, in accounting. Return of investment. Many of us do investment, but we don't calculate the return of investment. So, for example, if you are starting a business today, you anticipate that in 6 months, you should have had back your capital. So how do you do the marketing? How do you strategize to ensure that in 6 months, you have your capital back? So you will use the income statement to calculate the return of investment, because the income statement will give you a net income and things like that, gross income, net income, etc. But the balance sheet is used to calculate the liquidity and solvency ratios. Like I was talking about current ratio, just the strength of the company. You can have profit, but you are not strong enough. Yeah, you can have profit from your income statement. Over a period of time, you can have profit. But from your balance sheet, it shows that you are not very strong. Maybe you have many investors and you give them dividends, and they are left with very small money, things like that. So example is, did the company make a profit this year? That's the questions you ask. So when you ask these questions, when CEOs ask these questions to accountants know where to get the answers. Did we make profit from the sale of this product? How much did we make this month? They know where to get it. You get from the income statement. But if they're not asking questions like, what does the company own and owe right now? How much do we owe? How much do we have as debt? Once the questions like this start coming up, the accountant knows where to go and get it. That's why accountants must keep their books in check. Their cash book, all those books, they will keep. In fact, they have softwares now that once you record the transactions on a daily basis, those software, QuickBooks, SaaS, all those software, they just automatically prepare some of these things for you. But with our Excel for career upliftment, you can manage only even with your Excel. So let's see an example of an income statement. You see, an income statement, most often you can do it for 2 years, so that you can compare. This is not a financial analysis, because you compare the previous period and the present. That's how you should know if you're actually making profit, right? Because you cannot calculate profit on one thing. You must compare it with another. So this one is an example of a company, for example, A to Z Corporation income statement. You must always have this kind of heading. You must tell us the type of financial statement and the period. These are standards. I always say a rule of thumb. So we have for the year ended December 31st, maybe 2025 or something, you write it down, or 2024, since we have 2024 and 2023. So this one, we have these major headings too. Remember, for the statement of cash flow, we have 3 major headings: operating, investing and financing activities. For this income statement, you have 3 or 4 major headings as well. You have revenue, you have expenses, very important, you have taxes. This is where you get your taxes. You cannot see taxes in the cash flow. So for revenue, you tell us the sales revenue or cost of goods sold, right? You must tell us how much came in for that period. So this money is this money comes from which book? From your cash book. How much revenue was made for that period? You write. Now, what was the cost of that product? If you sold printers, you sold maybe toners, as we gave example last time. How much did you buy them? That's the cost of goods sold. And where do you get this cost of goods sold? You get it from your stock register. Because when you register the stock, you register the amount, right? So that's where you get it. You cannot get this out from your cash book. You get it from your stock. So you must be able to know all those financial statements for those recordings. So now your gross profit now is your cost of goods sold, your total revenue minus the cost of goods sold. It's still gross profit. Why? Because you have not yet deducted your taxes, maybe salaries and other things. Once you remove all those other ones, what you're left with is your net profit or your net income. People always confuse income and revenue. Revenue is money that comes in from the sale of products, but income, in particular net income, is your profit. All right. So expenses. So you have had revenues. Now you have expenses. You might be thinking that why is cost of goods sold under revenue? It is under revenue because it is a subset of what brought this revenue. It is what brought this revenue. Because you might be thinking that because of goods sold is not a revenue. It's no money that came in. Why is it under the heading revenue? It is what generated this revenue. It is this good that you sold that gave you this revenue. So you should fall under this heading. You cannot put it under expenses. Expenses are things now that an indirect expenditure that does not come from the, how do I put it? These are other expenses that you cannot directly trace it to a particular product, because here you can trace this cost of goods sold to the goods that you sold. But the rent, can you trace your rent of your store to a particular product? No. Utilities, electricity bills, water, miscellaneous expenses, small, you buy granite is passing, you buy and eat, pay transport, you can put those on under miscellaneous, and all these things are registered in your cash book because you register expense there. So you go there and you get this, and you put, when you do it all, you sum it. Now, other revenue, you can have other revenue, maybe from other things, maybe, I don't know, maybe some other things not from these products. Yeah, maybe somebody came and gave you some money, or maybe like those who deal with drinks, maybe Brazzers has given you, how they call it? Is it they say Brazzers give some money at the end of the year to people who sell drinks? That's other revenue because it didn't come from the sale of drinks, right? So this one, you put it here. If you look at this, the sum is the sum of each heading. You sum each of it for each year. Then your taxes, now maybe you paid your taxes. Then your net income, look at the formula for net income. It's B15 minus B16. What's B15? If you come to B15, is other revenue minus B16. What's B16? Is your taxes. All right. So what happens to, did I put this formula right? Let me see. Because you're supposed to get this gross profit minus, okay, let me see this other revenue. Did it come from somewhere? Let me see. All right, perfect. Because I was wondering why have I not used this 60,000? So this other revenue was gotten, anyway, this theoretical, it was gotten from subtracting all these other expenses from the gross profit. All right, this theoretical, but in reality, you should have this other revenue maybe from other sources. Their net income now should be what? Should be other revenue plus the gross profit you got here minus your taxes. So when you have these two, you can compare now and see In 2023, you had 29,675. 2024, you have 38,750. So indeed, you made profit. You made profit because you can now take this year minus last year. You see that it'll be positive. So the company made some profit. So that's how you calculate your income statement. Then, how do you do your balance sheet? Where is that one for balance sheet? Balance sheet is also very easy. If you track, people always have issues with this because they don't track their income. They don't have all those books we saw last time. When you have all those books, you will not have issues because the balance sheet has your assets and it has your liabilities and your equity. Equity is maybe shareholders' equity when what they own, money that people have invested in your business. That's equity. And the total must always be what? Assets minus liability plus the equity. So if you sum liability and equity and subtract from assets, it should always balance, right? That's what we call a balance sheet. If it doesn't balance, then it's an issue. For example, if you take 140 plus 160, it's 300, right? So subtract from this one is 0. That's why they call it balance sheet. So if it doesn't give 0, it means there are issues somewhere. So this is just how it's just this simple. So it's a snapshot. So there's no say for the year ended, as you can see this one. So this thing here is very important. It says at December 31st. Unlike the other one which says the year ended December 31st. So that's to tell you that it's just a snapshot. This is just the position of this company as of this date. So the current asset they have to, this one you have to value all your assets, all the laptops you have, all the land you have, all the equipment you have. You value present value. You give that present value. Sometimes you can buy a piece of machinery and you put the precision, like maybe it is a way to calculate the precision, 5% times what, calculate it. So at any point in time, when you go to your fixed assets register or to some of those assets, you should be able to get the value out of that day, and you put it under current assets. You put the value here, cash and cash equivalents, money from your cash register or from your statement of cash flow. You can get it here. Accounts receivable, this one, account receivable is money that you are still to receive. You have already given out goods, money has not yet come in. So there is from debtors register. Inventory from your stock. You must value all what is in your store, in your warehouse. Non-current assets. Non-current assets. Assets that what non-current assets? Things like land. Let me quickly let me not say something that when you don't revise these things for some time, you get to. So example of non-current assets. So the asset that you hold for more than 1 year. So I was right. Land is an example. You wanted to confirm. Land, buildings, vehicles, things that you hold for more than 1 year. Those are long-term assets. So non-current assets. Those are just the difference between current and non-current assets. Current assets are assets that you use for 1 year. You are assuming that they should be able to be used up or get away after 1 year. Yeah. So you get all of that and you sum it. Then we have liabilities, current liabilities. Yes, the people you owe, depreciate, all those kind of things, people you owe and all that. Current accounts payable. Accounts payable is now money that you have to pay to your creditors. Those who have supplied goods to you and you're still owing them. It's a liability, right? Because money has to go out. So you have to pay that one. Then liabilities can be things like maybe your rent, fuel, and all that. Money that is salaries, money that is going out. Short-term loans that you can pay within 1 year. It's just the same financial term. Short-term things I can do for 1 year. Long-term things that can be done for that can exceed a year. So non-current liabilities are liabilities that, maybe you took an investment, you took a loan that you have to pay for more than, like people who take loan and they have to pay for 5-10 years. Those are non-current liabilities because you have to pay interest for more than a year. Then we have long-term debts. Yes, you can take a debt that you pay maybe after 10 years. People will take loans of 10 million, you cannot pay in a year. So those are all liabilities, and you put them here. Then your equity and the shareholder equity. So this one can be your own capital that you put in your business. What I mean by equity is maybe your own, what you put in your business as capital. Your own capital is your equity. Then shareholder is what people invested in your business. And if you sum all of this, if you calculate it very well and you sum liabilities and equity, it should give you what your assets are. That's why they call it a balance sheet. So you must balance. So it gives you a snapshot of your business. So when I look at this business, I see that you have more assets than you have liabilities. You have assets worth $300,000 or francs, and you have liabilities worth 160,000 francs. It means that you are in good standing. But to go further, to know if you're actually in good standing, you must do financial ratios. You must calculate all those financial ratios that I was talking about, which is an assignment that you can read: current ratio, debt to equity ratio, uh, return of investment, and all that. There are many things, even what they call, is it NPV, non-profit value or something like that. All those terms, those are deep financial things that you can go deep dive into them, but you can leave it for accountants. But for your business, you'll be able to track it from the cash book, creditors book, debtors book, stock card. When you have those ones, you can be your cash statement of cash flow, you can be your income statement, and you can be your balance sheet. And for those who NGOs who want to apply for grants, most granting agencies always ask for your account statements at the end of each year, because they cannot give you a loan. Most companies, most granting agencies cannot give you a loan that is worth more than twice your net income or your income for the previous year. So they always ask for these statements. If you can prepare them like this, you prepare, your accountant will sign, and then you can get your bank statements to further prove that money came in and went out, and things like that. All right, so that's it for today. I don't know if you have any question, something you want us to talk about before we say we call it a day. Seems no question. All right.